Welcome back Friday morning here on Squawk Box. Real estate investment trust REITs have grown in popularity, but have also suffered along with the global property sector during the downturn. But they are considered, though, a low-risk security and have the advantage of paying dividends. So are REITs the place to put your money? All right, let's get to Peter Churchhouse, Director of Property at Lim Advisors. He joins us live from Hong Kong. Staying with us here at our Asia headquarters is Solomon Hyder, Managing Director and Head of Wealth Management at Citibank Singapore, our guest host. To both of you, good morning. Peter, welcome back. It's been a while. So REITs taking a knock along with bricks and mortar property. You think some of it is unfair?
I think, yes, it is, quite frankly. I think risks are much lower in real estate investment trusts than traditional real estate companies. Now, I was interested listening to Salman's remarks about pension planning. To me, real estate investment trusts fit very neatly into pension planning. They're partway along the risk spectrum, if you like, from very volatile equities to the more sober bond market. So I think they fit in very nicely. I could build a portfolio today in Asian real estate investment trusts that'll give you a dividend yield of between 10 and 12%, even now in today's property market. So I think that's a good thing.
Oh, 10 and 12% sounds pretty good to me, and I'm really curious. A, is this net, and two, talk us through names. Where, who?
Well, for example, in Hong Kong, most of the listed REITs are yielding you right now, even at today's prices, with the REITs having risen quite sharply in the last couple of months, are giving you yields of 11, 12, 13% in 2009. In Japan, where interest rates are much lower and yields are much lower, I can still find REITs that are yielding me between 9 and 11, 12%. In Singapore, 13, 12, 11, 14%, and in some cases as high as 20%. So they're out there, and they're still very cheap right now.
Salman, go ahead.
Well, I think I completely agree with Peter. I think it makes a lot of sense to have REIT exposure. Peter, just in terms of outlook, you know, we've got an economic environment where we're expecting to see deterioration in terms of the economy, and because of that, our analysts at least are looking at REITs suffering a little bit in terms of demand for office space and residential space. Asia, far more resilient, but any concerns there in terms of how you look at the rest of '09 for REIT exposure?
Oh, absolutely. I think quite clearly the office markets in just about all of our major markets are trending downwards right now, both in terms of rents and in terms of asset values. The residential market's probably a little bit more stable, and you're seeing that reflected in the performance of the Japanese residential REITs in the last couple of months have actually picked up very, very nicely indeed. But absolutely correct. The discounts to net asset values that the REITs are trading at are about 40 to 50% right now, and that is building in an expectation that asset values in the property markets will come down. But I think they've probably over-reflected the downside risk in many cases.
Which seem to be. I think that's interesting because in light of how I wanted to pick on your intellect a little bit more in terms of, I saw a research note that just came out of Citi about the Shanghai test case for REITs, because they're setting up a REIT structure in Shanghai, looking at, I think, the Pudong area and seeing how they securitize that, and I think they're still trying to see whether it'll go a debt-like structure, an equity-like structure in terms of ownership of the underlying properties. A lot of benefits if Shanghai REITs work and how that develops for China. Any thoughts on that, Peter?
Oh, absolutely. I think REIT industries tend to develop out of distress in real estate markets. If you look at the Australian REIT industry, it grew very rapidly out of the distressed system real estate assets in the late 80s, early 90s. The same in the US, and I think in China you're going to see a lot of distress in real estate assets as well. So as these things come onto the books of the banks with people who can't repay debt and so on, securitizing these into portfolios of real estate trusts is it really does meet a need here. And secondly, I think it also feeds very well into the growing pension issues that we're seeing in China, the need to provide for pensions over the long term. So I think the REIT structure will work very, very well in China in the long term.
We'll be watching. Interesting stuff. Peter, great to talk to you, sir, as always, and very useful. Peter Churchhouse, Director of Property at Lim Advisors up in Hong Kong. And we need to say thank you also goodbye to our guest host, Salman Hyder, Managing Director, also Head of Wealth Management at Citibank in Singapore. Okay, we're counting down the start of Hong Kong trade now, 9.5 minutes away. We'll help you get set up for a trade for the Hang Seng this Friday when we come right back. Don't go away.